Monetary policy refers to any policy tools that affect the price or quantity of money. Obviously, here the price of money means interest rate. So, whatever policy is used to influence the interest rate and the quantity of money, that is called monetary policy. Monetary policy, like fiscal policy, is a demand side policy as it seeks to influence aggregate demand. Monetary policy would be contractionary and expansionary. We will study soon in the next slides. Monetary policy tools are usually applied by the central bank of the country. Obviously, monetary policy is designed by the central bank of the country. Our interest rates, changes in money supply, credit regulations, and exchange rates. Tools of monetary policy are actually the instruments used by a central bank to manage the money supply, influence interest rate, and stabilize the economy. Contractionary monetary policy. Monetary policy is contractionary when the target is to dampen demand. When the central bank wants to reduce aggregate demand to control the rate of inflation mainly, and up to a certain extent, this would always also negatively influence imports. Imports would fall, and an spare capacity for exports will increase. However, here we want to talk in the context of inflation. So whenever a central bank would observe that the rate of inflation, the actual rate of inflation is above the target rate of inflation, which central bank set, central bank would adopt contractionary monetary policy. It will adopt those policies which will reduce aggregate demand, and when aggregate demand will go down, the rate of inflation will go down. The first thing which the central bank will do in the contractionary monetary policy, it will increase the interest rate. We already know that when interest rate will go up, savings will be discouraged and borrowings will be encouraged, because reward on savings is being increased and the cost of borrowing is being increased. As a result, savings will rise and borrowing would fall. That would result in a fall in aggregate demand. When aggregate demand would fall, inflation rate will go down. Apart from that, when interest rates will be increased, obviously people would be having lesser money available to spend on imported goods as well. As a result, demand for imports would also fall, and since the demand for local goods is falling because of a fall in aggregate demand, then an spare capacity for exports would develop. However, again, mainly relating to inflation, an increase in interest rate will increase savings, will discourage borrowing. As a result, aggregate demand would fall and inflation rate will go down. One important thing has to be discussed here, that how will the central bank increase the interest rate? Actually, there are two ways of increasing the interest rate. First of all, the central bank can reduce the money supply. When money supply would fall, obviously interest rate will go up. Or second thing which the central bank can do, can increase the base rate. Let me explain both the things. Base rate, which are also referred as repo rate or rediscounting rate, is the interest rate which the central bank is charging from the commercial banks when central bank is lending to the commercial banks. We have already studied this, that central bank is the lender of the last resort. So whenever commercial banks are facing liquidity problem, they ask for loans from the central bank. And the rate at which the central bank lends to the commercial bank is referred as base rate. So if the central bank will increase the base rate, then obviously to keep their profit margins intact, commercial banks would also increase interest rate. Let's assume that central bank is the wholesaler and commercial bank is the retailer. So when the wholesaler will increase the price, then in order to keep its profits intact, retailer would also increase the price. Likewise, when central bank increases the base rate, commercial banks increase their market interest rate. So central bank influences the market interest rate by increasing its base rate. Secondly, central bank can reduce the money supply in order to increase the interest rate. How it can reduce it? Central bank would start selling bonds to non-bank private sector. When central bank would start selling non-bank bonds to non-bank private sector, the price of bonds would fall. As a result, non-bank private sector would buy more bonds, and to buy bonds it will withdraw its money from the commercial banks accounts. So commercial banks will be used to withdraw amount and people would be buying central bank bonds. So bonds are coming to the people, money is going to the central bank, and commercial banks would face withdrawals. As a result, liquidity of the commercial bank would be negatively influenced, and that is referred as a fall in money supply with the commercial banks. And this activity which I discussed is called open market operations. The selling of bonds by the central bank will result in a reduced money supply with the commercial banks, and that is referred as open market operations. Second thing which the central bank can do for contraction, it can reduce the money supply or it can slow the growth of increase in money supply. Monetarists believe that inflation is always caused by excess of money supply over the value of GDP. It is a situation when too much money is chasing too few goods and services. Whenever money supply would exceed the value of GDP, aggregate demand would exceed aggregate supply because people are having more money with themselves, but the value of goods and services available in the market is not enough. As a result, there would be excess demand in the market, and that would lead to higher prices. That's why Milton Friedman somewhere mentioned that inflation is always a monetary phenomenon. Inflation is always caused by an excess of money supply over the value of GDP. That's why the second thing which the central bank will do will reduce the money supply. How will it do it? I have already mentioned, with the help of open market operations. It will sell bonds to the non-bank private sector. When non-bank private sector will buy central bank bonds, it will give money to the central bank by withdrawing it from the commercial banks. As a result, commercial banks' liquidity will shrink, and that is actually a fall in money supply, which we are talking about. Credit regulations. Central banks may also impose credit regulations on the commercial banks to help maintain financial stability and to influence the bank lending. Most central banks require the country's commercial banks to hold a proportion of their assets in a form that can be quickly sold and converted into cash. This is to ensure that the commercial banks can meet their customers' likely demand for cash even during a financial crisis. Actually, whatever deposit is coming to the commercial bank would obviously like to lend whole of the amount. Commercial banks are usually imprudent. They focus less on maintaining liquidity, more on making profitability. And to make profits, they will try to lend as much amount as possible to the borrowers. But the problem here is that, that if too much money is lent, then no money would be left over the counter to meet the demand of the customers, right? If the customers will come and they will demand their money back, And if the commercial bank is not having it, because commercial bank has lent most of it, then people would lose faith on the banks, and that can result in banking crisis. That's why central bank forces commercial banks to maintain enough liquidity. Secondly, maintaining that liquidity would also limit the ability of the commercial banks to lend if the central bank wants to contract the economy. What would happen? That when central bank would force the commercial bank to maintain more cash reserves with them, then obviously the commercial banks would not be in a position to lend enough, and their credit creation ability would diminish, and that is referred as credit regulation. Central bank will force commercial banks to maintain more liquidity as compared to lending, advancing the cash, and in that situation, that would be classified as a contractionary policy. Revaluation. Revaluation is not a policy which is frequently adopted to control inflation. Obviously, we already know that revaluation can control inflation, but on the other hand, it would negatively influence the current account position of the country. However, let me explain what revaluation is. Revaluation is a deliberate upward adjustment of a country's official exchange rate relative to foreign currency. For example, if $1 was equal to 100 and Pakistan's government is doing revaluation by 10%, it would mean that foreigner against $1 will now have only 90 rupees. And to Pakistani people, $1 would be available at 90 rupees. As a result, exports of the country would become expensive because the exchange rate is appreciating, and imports would become cheaper. Exports would fall, imports will increase, and when exports would fall and imports will increase, aggregate demand would fall, and when aggregate demand would fall, that would control demand pull inflation. Moreover, when imports are becoming cheaper due to revaluation, imported factors of production would become cheaper and cost push inflation would go down. But again, this is not a frequent measure because revaluation would destroy current account position because exports would decline and imports would increase. Now, having discussed the contractionary policy tools, which I mentioned as increasing interest rate, reducing money supply, revaluation, and credit regulations. Now, let's discuss the limitations of a contractionary monetary policy. This part is very important for writing evaluation in exams, mind it. That whenever they are asking some question about monetary policy or interest rate, these points would be written in the evaluation part of the question, and that's why the most important part. First point is increase in interest rate base rate by the commercial bank may not discourage consumption expenditure if commercial banks do not increase their interest rate in line with central bank base rate. What is the point here? Sometimes central bank will increase base rate due to which the cost of borrowing of the commercial banks will increase. But despite of an increase in cost of borrowing, commercial banks would not increase their interest rate if they would believe that demand for credit is interest elastic. If demand for credit is interest elastic, any increase in interest rate by the commercial banks would result in a more than proportionate fall in demand for credit, and that risk the commercial banks would not like to take. That's why they would compromise on their profit margin. They will not increase the interest rate in line with the interest rate set by the central bank. That's why consumption, borrowing would not be discouraged, therefore consumption would not be discouraged, and contractionary monetary policy would not work. Secondly, even if the commercial banks increase interest rate, people may not avoid to borrow if they are optimistic about the future. If they are feeling that their incomes would remain intact or they will grow, If they believe that economic conditions are good, favorable, then even despite of an increase in interest rate, they would not compromise on borrowing because they feel that their income level would increase more than interest rate and they would be able to afford higher interest rate, so they would not compromise on their expenditure, and as a result contractionary impact would not be felt. One of the biggest problem is that an increase in interest rate would negatively influence the investment. If interest rates will be increased too much and the investments would keep on falling, and if they fall below depreciation, if they fall below what is required, what investment is required to replace the previously depreciated capital, if investment falls below that, that would result in a fall of aggregate supply. And when aggregate supply would fall, price level would increase. What I'm trying to tell you, that contractionary monetary policy or increase in interest rate were done to solve the problem of inflation, demand side inflation. But if the interest rates will increase too much, then the cost of borrowing for the firms will increase. As a result, their investments would fall, aggregate supply would fall, and that can create cost push inflation. So to control demand pull inflation, actually the central bank is creating cost push inflation because very high interest rates are increasing the cost of borrowing for the firms. Cost of borrowing is also a cost, and when the costs will increase, they would not borrow enough, investments would keep on falling, aggregate supply would fall as a result, and that would result in cost push inflation. One problem is that central banks may be worried that if they raise interest rate higher than in other countries, then it may attract an inflow of money into their financial accounts from abroad. This may increase their exchange rate, which would negatively influence exports and will result in an increase in imports. The point here is that if, for example, Pakistan increases its interest rate to a very high level above many countries' interest rate, then Pakistan would face an inflow of foreign currencies to be deposited in local accounts. And when foreigners will deposit their money into Pakistani accounts for earning a higher interest rate, then obviously due to inflow in the balance of payment, because money is coming to the economy, that would be recorded as an inflow in the financial account. And when financial account will improve, more money would come from abroad, then obviously demand for Pak rupee would increase, right? And exchange rate would appreciate. The problem with exchange rate appreciation is that it would result in a decline in exports and increase in imports. So a country already facing current account deficits will not attempt to do that because exchange rate will appreciate, and when exchange rate will appreciate, that would negatively influence the current account position of the country because interest rate and exchange rate are directly related. Whenever interest rates are increased, exchange rates go up. Whenever interest rate fall, exchange rate goes down. So when central bank will increase interest rate too much, exchange rate will also appreciate. That would negatively influence the current account position of the country. That's why interest rates cannot be increased much. The second point which I have mentioned here is the policy of revaluation. As we discussed, that policy of revaluation is a contractionary policy because revaluation would lead to lower exports and higher imports, aggregate demand would fall. So this cost of reducing aggregate demand is not good for the economy because that is destroying the current account position of the country. That's why the policy of revaluation to control inflation is seldom adopted. It is not a frequent policy which is usually adopted to control inflation. It is seldom adopted when the inflation goes out of hand. Government uses other policies to control inflation. Revaluation is hardly ever done. Okay, now expansionary monetary policy. Obviously, exactly the opposite of contractionary monetary policy. However, let me tell you that monetary policy is seldom expansionary. Usually, the target of the central bank is to control inflation. The main macroeconomic objective which the central bank wants to control, which the monetary policy wants to control, is the rate of inflation. But in the times of recession, central banks can adopt an expansionary stance also, right? Mainly when the rate of inflation is below the target rate of inflation. Then government, then central bank would attempt to increase aggregate demand, again by the same tools. What central bank will do to revive aggregate demand? You already know it now. Instead of increasing interest rate, it will cut back on interest rate. Instead of reducing money supply, it will increase money supply now. Instead of increasing credit regulations, it will decrease credit regulations. It will motivate commercial banks to lend more. And instead of revaluation, now the central bank will go for a devaluation. So these are the four things which the central bank will do. When interest rate will be cut, obviously cost of borrowing would fall, savings would be discouraged, aggregate demand would increase, GDP would increase, unemployment rate would fall. When money supply would be increased, people would be having more money with themselves. Again, aggregate demand will increase. When commercial banks would lend more as compared to before, aggregate demand will increase. And when devaluation would be done, exports would become cheaper, imports would become expensive. As a result, exports will increase, imports would fall, aggregate demand will increase, and GDP will increase, employment will increase. So with the help of these four things, central bank would cause expansion in the economy during a recession. However, this must be noted that currently I'm discussing the monetary policy of AS level. If I'll talk about the expansionary monetary policy in detail, then I will also discuss here uh, quantitative easing, right? Which I'm not including here because obviously this is AS level and quantitative easing is not the part of that. Now, limitations of an expansionary monetary policy. Previously, we studied limitations of contractionary monetary policy. Now we are discussing limitations of an expansionary monetary policy. Point number one, firms and households may be pessimistic during periods of recession or deflation, and so may not spend more even if there is more money in the circulation, or it becomes more cheaper to borrow. What does that mean? Obviously, during recessions, people are unemployed, businesses are pessimistic, they're uncertain about the future. So even if central bank will reduce interest rate, even if central bank will increase money supply, until and unless the people's confidence would not be revived, they would not borrow and they would not consume and invest. As a result, there would be no effect of expansionary monetary policy here. Secondly, even if interest rates are low and central bank is increasing money supply where the interest rates were already very low, an increase in money supply would not lead to lower interest rates because economy is in a liquidity trap. Liquidity trap is a situation when increase in money supply by the government is not causing any downward impact on interest rate because the demand curve of money has become perfectly elastic. Actually, the concept of liquidity trap is related to A2 levels, but here we have a little discussion over that. That liquidity trap is a situation when money supply is increasing, but increase in money supply is not able to further reduce the interest rate. And when interest rate is not falling, obviously aggregate demand is not increasing. because the liquidity in the economy is trapped, right? So these are two reasons why expansionary policy sometimes would not affect. One more point here in the limitations of expansionary monetary policy. Central bank may increase money supply, increasing the funds commercial banks have available to lend. But if the banks are reluctant to lend, because there are not enough credit-worthy borrowers, there are not enough reliable borrowers, where accountability is not possible, then and the commercial banks fear that those loans would not be paid back and they would have to be written off, then obviously commercial banks would not lend. Central bank is increasing the funds available to the commercial banks, but commercial banks are not willing to lend because the borrowers are not credit worthy enough, then obviously the effect of expansionary monetary policy would not be felt. I know that discussion has become too long, but only these 4 points are to be dealt now. Please don't go anywhere and please listen carefully because this is the main central idea of the whole monetary policy. Here we are discussing the effectiveness. Again, effectiveness has to be written in evaluation. So for evaluation, you have to understand these points. Number one is controlling money supply in practice is difficult. Actually, this is the idea of John Maynard Keynes. He said that if you will control some forms of money, new forms of money would become in use and money supply would be not in control. According to him, money supply cannot be controlled because of new old forms of money would be controlled, new forms of money would develop, right? So you can understand yourself that, for example, cryptocurrencies were not in existence before. If the central bank would control notes and coins, if the central bank could control deposit money created by the commercial banks, but central bank cannot control cryptocurrencies. Central bank cannot control bitcoins. So if old forms of money are controlled, new forms of money come forward and it is become difficult for the central bank to control money supply in practice. Second, again, the point of time lag, and that is that obviously it takes time for monetary policy to work. There are time lags, realization time lags, implementational time lags, behavioral time lags, right? Monetary policy is not a button which you press and the changes would come immediately. That would involve a time lag also. Then the third point I have discussed is that a higher interest rate will dampen aggregate demand. The problem with the contractionary monetary policy, mainly the problem with increasing interest rate, is that they would result in a fall in aggregate demand and would negatively influence GDP and employment. That's why contractionary policy is difficult to be adopted in this context. Then it can be difficult for a country to operate an interest rate that is different from other countries. This again is a very important point. For example, if you are a part of a European Union, if you're a part of Eurozone, so obviously you do not enjoy that much freedom in changing your interest rate because European Central Bank mainly is the sole authority. Yes, individual central banks have some freedom, but their freedom is supervised by the European Central Bank. They are not enjoying that much freedom. For example, Pakistan Central Bank enjoys total freedom because it is not the part of any union. But if I talk about Italy, if I talk about Spain, if I talk about Germany, they are part of the European Union, and European Union has its own central bank where monetary policies of all the countries are decided. So individual central bank does not have that much liberty and cannot change the money supply or interest rate by its own will, right? It does not enjoy that much freedom. So these are the points on the effectiveness of on the monetary policy. In the AS level, we discuss all these things which I have covered, right? For A2 levels, I will make a separate video on monetary policy. For O levels also. Currently, I'm done with AS level monetary policy. I hope the points are clear to you. I hope that you like the video, share it, and will subscribe the channel. Thank you very much.